UBS Chairman Colm Kelleher warning that a bubble is forming in private credit. We've talked a lot about the growth of that asset class. He says it could take, quote, just one thing to trigger a fiduciary crisis. The market has roughly tripled in size over the past 8 years. But if private credit is becoming too crowded, if you're nervous about stocks or maybe bonds, where else can investors turn for alternative assets? My next guest has an answer or two. He recently launched an ETF with exposure to various securitized loans, including mortgage-backed securities. Joining me now is John Kerschner, head of U.S. securitized products and a portfolio manager at Janus Henderson. It is great to have you here. Welcome.
Thanks, Kelly. Glad to be here.
I do think we should right away clear up the potential misconception that some of us have about whether CLOs were involved with the financial crisis.
And they were not. I know CLOs, one letter different from CDOs. CDOs, collateralized debt obligations, were made up of subprime mortgages.
Okay.
Subprime mortgages did not do well, defaulted left and right. Because of that, what was created out of them, CDOs, did not do well.
Right.
CLOs made out of leverage loans or bank loans, two names for the same thing. Those are corporate loans. They did fine through the global financial crisis.
They did.
And there's never been a AAA CLO that has ever defaulted in 30 years.
Does that worry you that now might be the time?
No, not really, because we do a lot of stress testing of our portfolios. And really what you need is a GFC times 3 or 4x. That would be an incredibly severe type of stress. And we just don't see that playing out right now.
We've talked about how the credit quality of major companies is almost better than that of major countries at this point.
Right.
Just look at the yields and what that's telling you. Look at all the cash that they have on hand. What makes CLOs different from, we mentioned the ETF you're starting. There's already an ETF for bank loans. People can go and get exposure to floating rate, which a lot of people like now because obviously it's been moving up. What makes CLOs more attractive as a product? What's the difference?
Yeah, and actually there are a lot of ETFs for bank loans. The problem is the bank loan market average credit rating is single B. It's actually very low rated. And so you have risks of default, particularly as rates have gone up because leveraged loans are floating rate. That interest expense is going to catch up to that.
Exactly.
The nice thing about CLOs is you're taking a very diversified portfolio of several hundred bank loans. You have a CLO manager managing it. You're putting a securitization around it that gives you additional protections. And then you have managers like Janus Henderson that are picking the best CLOs out there to put in the ETF. So you get cash flows, securitization, extra protection, and then the very top slice of the cash flows go into our AAA ETF, and that's why you have that protection and no AAA.
So they are still floating rate in contrast, for instance, to maybe the investment grade or junk bond market where things are a little bit more fixed. This is a bit of a departure, but I want to come back to the comments we heard about the warning in private credit earlier. The problems you're describing with floating rate loans directly bear on the success that private credit and private equity to some extent should have in the next couple of years. Do you think we should all, in pension funds, be a little bit cautious about those asset classes?
Well, I'm not going to speak for other pension funds, but why we like securitization is because you can still get exposure, but at much higher credit quality. And given that the economy is doing very well, but could slow down, we think that is imperative, that people don't reach for yield right now. You don't have to. Our CLO ETF, JAAA, was positive last year, and when most bond funds were down double digits, and it's up 7.5% this year. That's not best bond fund out there, but I think most people would agree that's a very attractive return, particularly for a AAA asset.